Hello and welcome to the first episode of the brand new season of What the FinTech, the podcast from the team behind FinTech Futures and the Banking Technology magazine. I hope that the new year has got off to a great start for all of our listeners and you're all excited for season 6 of your favourite FinTech-focused podcast. As ever, we'll be chatting with a host of experts to bring you even more insights into the wonderful world of financial technology over the course of this year. So we're very much looking forward to getting started. My name is Paul Hindle, editor at FinTech Futures, and to kick things off on this first episode of 2025, we're joined by Amias Gerety, partner at QED Investors. Amias, welcome to the show.
Thanks for having me, Paul.
Excellent. It's great to have you here. And how's the new year been for you so far? Excited to be the first podcast guest of 2025?
Oh, man, it's a real honor to inaugurate the season, but we've been busy already. So I think a lot of firms, basically, I think everybody in FinTech who had a good 2024 is out raising right now. So it's an exciting time, actually.
Excellent. We'll dive into that shortly. But just to get started, we'd like to quickly let us know a bit more about yourself now.
Yeah, sure. So I've been at QED about 7.5 years. I joined in 2017. And I'm a partner on our US investing team. So I focus on fintech in the US. I think most of my investing has been on what I would call the software end of fintech as opposed to the financial services end of fintech. But at the same time, probably my biggest, best company is Kin, which is a direct-to-consumer home insurance company. So, never say never. It violates the most of what I've been investing in, but it's an absolute monster. And we're very proud to be engaged there. And then before this, I spent 8 years at the US Treasury Department. So I joined the Obama administration on literally the first day, so January 2009, and I rode the whole roller coaster. So I left the Obama administration. My resignation was effective noon on Inauguration Day. So I did the full 8 years, really focused on designing, passing, and then implementing Dodd-Frank and a raft of post-crisis financial reforms.
Sounds great. Well, how did you move from that into the kind of VC space then?
Well, I like to say, Paul, dumb luck is the real answer. At QED, a lot of my partners are ex-Capital One, but there's a secret history of Capital One is that when Nigel and Rich Fairbank started Capital One, they started it as consultants. They were going around to the big banks telling them, hey, you could risk price your credit cards. And one small bank in Virginia, Signet Bank, said, hey, well, if you think this is such a good idea, why don't you come do it at my bank? And that consulting firm that they were at eventually got rolled up into Oliver Wyman. And when I was a consultant, I was at Oliver Wyman. So when I met the QED guys in the spring of 2017, after I'd left Treasury, it turned out that I had this shared historical DNA. And that sort of, I think, was enough to open the door for Nigel to say, oh, this might be interesting. And then the other thing, Paul, is around that time, we were making the transition from being kind of a functionally a family office, only partner money being invested, to taking other people's money. So I was symptom, not cause of our expansion, but I was lucky enough to join QED at right around the moment where we decided to become a true venture capital firm with a proper institutional capital base and a reasonably sizable global team.
Excellent. Well, sounds great. And again, it's great to have you here. And thanks so much for taking the time out to speak with us today. So on the show this week, we'll be taking a look at the ever-evolving fintech funding landscape and what the venture capital outlook for fintech in 2025 looks like at the moment, following a decline in global funding activity in 2024. And we'll also dive into the technologies and verticals that are attracting the most interest from VCs, how QED is approaching its fintech funding strategy, some key advice for founders when it comes to scaling a new startup, and of course, the big tech trends to keep an eye on looking forward. So to start off then, according to a recent report by Innovate Finance, global fintech investment fell by around 20% in 2024 compared to 2023. This is the third consecutive year in which global fintech investment has seen a decline, seeing a significant fall from the record funding that we saw in 2021. So Amias, I guess as we make our way through the first few weeks of 2025, what's the feeling in the VC investment space right now? Given the shape of the global economy, how do you see the fintech investment landscape shaping up this year? And is there positive sentiment at the moment?
I think the sentiment is really positive right now, Paul. Like I said, I think I'm not sure we've been overwhelmed, but we've certainly been whelmed by the number of companies, and in particular, the number of good companies with strong teams, strong performance that have been coming to market in this first couple of weeks of 2025. And I think we've also been impressed that the investor side has been very receptive. I think there's two dynamics to this. One is that the standards have been redrawn a bit. So we're basically seeing much more revenue growth, stronger kind of fundamentals when people are coming to raise. So a bit more rationality to say, I want to raise X amount of dollars. I've got these metrics, and those sort of match a little bit more closely than they did in 2021. And then I think on the other side, you see the sense, I think, again, which is necessary for all venture, that anything is possible. And I think AI really has reignited the animal spirits on that sense of, wow, this is a team and look what they're building, and they're building so fast and the traction is there, and maybe this really could redefine the industry. And I think that sentiment, that shared conviction between founders and investors is the other necessary ingredient. I think all that said, we are seeing a lot of still FOMO-driven deals where the metrics and the prices don't match. And to be honest, that makes us and me really nervous. It's very hard to win a game where some people are playing irrationally. But between all that, we do see a return to some rationality with just fantastic companies growing really fast, which is necessary for venture outcomes. And then simultaneously, a real conviction that anything is possible. We actually can redefine industries. And I think some of that swagger was lost between 22 and 23.
Excellent. Yeah. So, I mean, what kind of funding trends then are you seeing at the moment, and where are you seeing the biggest kind of levels of investment when it comes to fintech?
I think a lot of fintech investors, and QED is no different here, are starting to define the boundaries of fintech more broadly. Now, part of this is we've already invested in so many fintech winners. We can't go and invest in all their competition as well. We can't invest in Gen 1 and Gen 2. Like we just did, Kin is a good example. It's direct-to-consumer home insurance, focused on catastrophes. Started in hurricane, now just entered California. There are a lot of exciting insurance companies focused on California wildfire. I'm not going to invest in any of those because I've already got an investment in Kin. So I think as we do that, we've been really taking seriously the idea of enterprise technology, data science. What are some of the structures around which the financial services industry will need to change in order to facilitate the rise of AI? This is a thesis that I call the inverted AI thesis. So instead of investing in companies powered by LLMs, let's look at how the world needs to change in order for us to harness, capture, contain, benefit from the power of LLMs. And so that's an area that we're very excited about, and I think speaks to where fintech is going to change over the next couple of years in order to accommodate and accept this incredible power coming out of Silicon Valley and elsewhere.
Excellent. Yeah, well, as you mentioned, AI, it's obviously been a big focus across industries for the last couple of years now. A lot of money being pumped into AI-focused startups. As we talk right now, we've just had the launch of DeepSeek as well, which similar to the launch of ChatGPT in 2022, it seems to have caught the global tech industry's attention. I mean, do you see the focus on AI then continuing now over the next year, and how do you see that space evolving?
For sure. So a couple of things I will just say on DeepSeek. I don't believe that they did it with $6 million. I don't have any evidence, but I just don't believe it. At the same time, I think that their success, even if they did it with $1 billion or $2 billion, I think their success suggests that the power of LLMs may be more commoditized more quickly than we thought. From a fintech perspective, I think that's fantastically exciting. I've been doing a lot of work. I became a coder again when ChatGPT came out. So I'd done a very small amount of coding in college, a very small amount when I was a management consultant. You know, in management consulting, there's always someone who writes macros in the background of Excel workbooks and PowerPoints. I was one of those people, but I wasn't the best. I wasn't serious about it. With ChatGPT, and now especially with products like Cursor, I'm building. And that's really exciting, but I'm automating my own day job. I'm building a web app for my wife. And I will say that I can feel both the benefit of, and frankly, the excitement around the idea that things that would have been impossible are now easy. And I can constantly switch back. If I don't like the way Claude is behaving on something, I switch over to OpenAI. If I don't like the way OpenAI is behaving on something, I switch over to Gemini or Llama, although mostly it's the three that are hosted and served up through API. And I think DeepSeek, leaving aside the geopolitics of it, which I've already expressed some view about, I think still represents the idea that these LLMs make it be commoditized a lot faster than we thought. So from a fintech perspective, that's really exciting. And the reason it's really exciting is that if the game was all about who has the best LLM, then fintech was going to become not that interesting. But if the game is about who can take the power of LLMs and apply it carefully, considerately, then I think fintech becomes very interesting. And in particular, if LLMs have lowered the barrier to shipping a feature, then the usual moats of software are less important. But the old moats of access to scarce resources, ability to bring credibility into the financial services sector, ability to build a network effect, those moats actually become even more important when software and the ability to ship features gets easier. So that I think is very exciting. Although it's hard to ride these waves, it's hard to surf these waves when it feels like every day or every week there's a new technology announcement that is breaking new barriers in AI.
Yeah, no, for sure. I guess that's the thing, is trying to keep up with all the different innovations that are happening in the space at the moment. So I guess with so much focus on AI at the moment, are there any areas that you feel are maybe being particularly underfunded at the moment that maybe deserve more attention?
I think the one way that we think about this is that many of the teams, many of the startups, especially at kind of the very earliest stages, are saying, hey, wow, like I could apply AI to this. I could put a chat bot here. And I think those things end up being very thin wrappers that will not create enterprise value over time. And one example is in compliance. In anti-money laundering, or one of the core requirements is that you have to think about a customer and then write a report, like a tiny little report. But it always takes 10 or 15 minutes for an analyst to say, read the news about a person, write up whether they think they're high, medium, or low risk. And we've seen a number of startups over the last year plus say, oh my gosh, AI can write the report. So now it can be fully automated. Now that starts off saying, oh, well, wow, because I was on the board of a company called Arachnus in London. We invested in 2018. If we had been able to write those reports, Arachnus would have been $1 billion company. It just would have. And we tried really hard and we couldn't get it quite right. But the problem is now anybody can do that same thing because it's really just applying some robotic process automation to the LLMs. And we've talked to some of these companies in the recent past, and some of the best ones have actually said, initially we thought that AI was the secret sauce here. Now we realize it's not. Now we realize that the secret sauce is constraining the use cases, constraining the AI, going deeper onto robotic process automation, figuring out the edge cases. And sure, AI is necessary for that, but the real value is coming from sophisticated understanding of what's necessary and excellent product execution. And I think that is, in some ways, a back to basics moment. Is yes to AI, but now after AI, we reset the playing field. So just the application isn't enough to win. You have to reset the playing field in the age of AI, and the old things of how sophisticated are features, how good are your products, how do you handle those edge cases, can you bring credibility to the problem? Those are the classic problems of fintech. And we're finding that even teams that started off thinking, oh my gosh, this is great, I'll just drop in a chatbot, are now rediscovering that some of the old logic still holds.
Sounds good. And you mentioned at the start, one of your focus areas being that like back office technologies. But FinTech Futures, we take a keen interest in core banking technology. So what new developments are you seeing there at the moment and that banks should be keeping an eye on?
I think the cores are very big and very old. They are all of them trying to figure out how to rebuild on more modern stacks, make themselves more API friendly, make themselves easier to engage with, make themselves more modular. And I think this will be interesting, but very difficult. One of the things that I'm tracking most closely, I'm friends with the relatively new CTO at Jack Henry, Ben Metz. Ben came from fintech. He has a mandate to completely rebuild the core at Jack Henry. That's a super exciting project. I don't know how quickly it will affect the fintech landscape, but I think it's a really exciting project in banking. I know that FIS and Fiserv are doing similar projects underneath the hood. I'm also on the board of a company called Treasury Prime. Treasury Prime is really a software layer that connects fintechs and banks. But I think as fintechs and software companies, I think as the world evolves, people are recognizing that you need an API layer to connect to your bank and to any new effort that you want to do. And so one of the things that we're finding with Treasury Prime is that many bank customers are now coming to Treasury Prime and saying, hey, rather than use Treasury Prime to connect to fintechs, can we use Treasury Prime to connect to ourselves? So I think that is a really exciting dynamic. So in core technology, I think you'll see one of two things happen, and it will happen differently in different places. But either the next gen cores will become so easy to use that companies like Treasury Prime will not exist, or companies like Treasury Prime will prove that it's just too hard to build both the core and the middleware layer across all the multitude of systems. Many banks have many cores, they run different generations, et cetera. And so that unifying layer will be a place where value shifts. And I think that's a contest in the deep tech of banking that we are not quite sure how it plays out. And I think that entire area has been maybe a little bit distracted by the question of how do I connect to fintechs? But the real game is how do I modernize? How do I create nimbleness? How do I actually push forward?
Welcome back to What the FinTech. The Banking Tech USA Awards 2025 are officially open for nominations. If you've launched a game-changing product, achieved outstanding results, or set a new standard in banking technology, this is your moment to shine. Submit your entries by the 7th of February 2025 to be in the running for industry-wide recognition. Don't miss the chance to celebrate your team's achievements and gain the spotlight you deserve. Visit informaconnect.com/banking-tech-awards-USA for all the details and categories. That's informaconnect.com/banking-tech-awards-USA. Don't miss out. Get those nominations in.
So the US continues to lead the way globally when it comes to fintech investment. What would you say are the key factors driving the growth of fintech in the US?
Well, I think the first thing is we just remain the biggest market, but we're also most developed banking markets are extremely concentrated. And that really does cut down on innovation. Whereas I know that there's a lot of complaining about innovation in the US over time, but the truth is we have 50 laws, we have 50 states. So if you want to do an experiment, you can actually just go to Montana and register there. We often talk about in the US, should we have a sandbox? What would we do if we could have a sandbox, et cetera, et cetera. One of the reasons why the FCA has a sandbox is that you're not allowed to be a financial services company without federal registration. Whereas in the US, you can just register in one state. You don't need to be federally registered at all in order to get started. And I'm fond of reminding people that the GDP of Virginia is 7 times larger than the GDP of Singapore. So you don't have to just think about the Singaporean sandbox. You can just go to Virginia. I think that's the first dynamic, is that although there's a lot of complaining, we remain extremely vibrant, extremely fragmented in the US. And that gives lots of opportunities to find different ways to partner, to find different ways to experiment. And I think that drives it. The second thing is we have an ecosystem, and it's mostly good for the US, although it makes my job hard. If I invest in a company, the chances that a competitor gets funded actually goes up, not down, right? So if I there are enough great firms and there are enough great teams that the impact of me announcing that I've led a Series A in Company X, the signal is, oh, wow, Company X, the theme of Company X is now investable. Oh, someone else smart thinks that, oh, I'll go find my own team to back in that space. So we definitely see that in the US. Now, that makes my job hard. It wouldn't be true in some other countries around the world where there tend to be a little bit more king-making dynamics. But from the perspective of US innovation and US growth, it's obviously fantastic for our economy to have this much competition and this much vibrancy.
Excellent. Yeah, I mean, sticking with the US, as we record now, it's been just over a week since Donald Trump's inauguration as president. What kind of impact do you see the change in administration having on the US fintech sector in general?
So I think the first order impacts are positive. There's a lot of bullish sentiment, whether that's M&A and the idea that it'll be easier to buy companies, whether that's deregulation and the idea that it'll be easier to do experiments, or you won't have to think so much about the potential for enforcement or potential for supervisory crackdowns. I think those are all the first order impacts, and people are generally celebrating them. I think the second order impacts are a little bit darker. And in general, although again, people complain about regulation, I can tell you as someone who wrote Dodd-Frank that the problem in the crisis wasn't too much regulation, it was too little. The problem with the crisis wasn't too little innovation, it was too much. And I think that the nature of financial innovation has two dynamics. One, fintech mostly is about how do we do things better, faster, cheaper. But inside the banking sector, most financial innovation in history has been geared around the following question: how do we apply more leverage with less oversight? And the first type of innovation, I think we could do well to make sure that there's more of it in the US economy. But the second type of innovation, I think we should be worried about over time. And I think the natural politics of quote unquote innovation are to bundle both of these things and not make a distinction between the two. And I think that's the place where we're a little bit more worried. The other thing that I think is worth noting for everyone in the financial services sector as a person who lives in DC is the scale of disruption inside the federal government is much more significant than people realize. So it's a popular thing to say, oh, all those bureaucrats, blah, blah, blah. But the truth is, having been inside, most of those people have a good reason to do their jobs. And when you get rid of them, you actually lose something important. And you don't necessarily know that you've lost it in the first day because they exist only for the purpose of when something goes wrong. So a good example of this, we have inside the Treasury Department something called the Terrorism Risk Insurance Program. So after 9/11, the government said, look, losses from terrorist attacks over $100 million will be reinsured by the federal government. There are a group of people, 5, 6 of them, who have been employed more or less full-time for more or less 25 years to run a program that has never been used. So to a first approximation, you'd say, well, gosh, that's incredibly wasteful. It's never used. Maybe we could do it with one person. But to a second approximation, you'd think, well, what if there were a terror attack? You'd actually want that program ready to go. You wouldn't want one person's, or there you got one person and now that person retires. And then where were we? So I think these are the things that people outside of Washington sometimes can have a hard time understanding the downside risks of.
Yeah, for sure. I mean, it's in general, I mean, how do you see the regulatory landscape around financial services evolving then over the next 4 years? So?
Yeah, so I think it comes in 3 waves. The first wave is you're already seeing these proclamations, these executive orders, these policy statements. The second wave is actually trying to change regulations. And then the third wave, I think especially for fintech, is sort of this question of will there be structural change or will there be new charters, new applications, new banks? Those things take longer. So I think we'll sort of see those things come out over time. So you can already see a number of policy statements related to crypto. The assumption is that Paul Adkins will become the chair. Hester Peirce, who's a commissioner, has sort of taken the realm on a crypto task force. She is well known as an extremely libertarian person and very pro-crypto. So you'll see those sorts of policy movements first. Then I think, remember, we still do operate under the Administrative Procedures Act. That means that writing a rule or changing a rule takes years. So that will sort of play out over time. And then I think thirdly, you'll see sort of a wave of people saying, well, can I register a new security type maybe, or can I become a new kind of crypto exchange, or can I get a new bank charter, those sorts of things. And those will require business actors look at the policy changes, think about them, and then take action that follows. So I think that's sort of the path that we'll see over the next couple of years.
Excellent. That sounds good. And I mean, on the regulatory front as well, I mean, banking as a service has been in the spotlight over the last year or so now. I mean, what do you think is next for banking as a service in the US?
So I think here too, right, there's a person named Travis Hill. He's the way the FDIC works. The FDIC is one of the 3 banking regulators. They regulate most of the small banks. So actually from a banking as a service perspective, they're probably the most important regulator. Travis Hill has been the Republican commissioner. So they always have a party in power, other party structure between the chair and the vice chair. So Travis has become the chair. In his very first statements, he was very positive on innovation, very positive on the possibility of partnerships and technology being necessary for financial services. So again, I think you see already the policy movement moving in a kind of pro-innovation and therefore I think pro-bank partnership dimension. I think the second thing, which is harder to move, is to actually change the culture of supervision. And one thing that I often say is that enforcement actions are the love language of supervisors. This is a bit unfortunate, but this is how supervisors figure things out. And remember that individual supervisors, their number one concern is the bank I'm supervising going to fail. So it's very difficult, even if there is policy change at the top, to get a supervisor to change their tone if they believe that something is very risky, because that creates a lot of personal risk for them. And these are people, generally speaking, who maybe they're at the FDIC for 20 years or 30 years. They don't have these jobs because they're seeking a lot of personal risk or a lot of personal reward. So if you're the supervisor of a small bank in state X, you don't really want to change the policy if you think something is risky. So I think supervision acts as a kind of a ballast or an anchor to how much or how quickly the policy can move things. And it does have has a small c conservative bent, which tends to be slightly anti-innovation. So I think that's a movement that will remain contested even now as the policy change from the top has been clearly announced by Travis Hill.
Obviously, with your role, you work with a lot of fintech startups, a lot of founders. I mean, what tips or advice would you give to budding fintech founders and looking to get started in the current economy and get that initial funding?
Yeah, so from a regulatory front, I think the number one thing to remember is that disruption is kind of the wrong frame. Partnership is the right frame. You can't move money without a bank charter. So you've got to find a bank that you can work with. And I think too often, both banks and startups have started to think about that or were for a time thinking about the other as a light switch. Oh, I'm a bank. I want more deposits. I just press this fintech button and the deposits flow in. And I'm a fintech. I need a banking partner. I just press this button and my bank, I get regulatory access. And I think what we learned over the last couple of years is that these need to be partnerships. And that means you actually need to trust the other person. You need to know the other person. You need to understand what they're doing, what their strengths, what their weaknesses are. So my advice to people is, remember, if you're going to be in this, you have to be in it in the long term and you have to take it seriously. And that means finding not just a person who says yes or a person who will give you an extra couple of basis points, but an actual partner in the economic project of bringing financial services innovation. So I think that's the number one thing that a lot of these startups in the move as fast as I can mode sometimes miss.
Yeah, and I guess once they've got that funding, once they've got those partnerships as well going forward, what would you say are the key challenges then for founders when it comes to growing and developing their business, maybe taking it to the next level? And what advice would you give to founders for overcoming those?
Yeah, we always say there's no reason anybody should ever do business with a startup. You're small, you're new, you don't really have your product built out. So the only reason is if you've got something really special that you're offering. If you're just offering the incumbents plus 10% or the incumbents but a little bit cheaper, that's not really innovation. That's not going to create enough to create preference. So it's really the old saws of how do you deliver a truly novel, truly differentiated experience to your customers? And hopefully you're doing that not just by subsidizing them with venture capital dollars, right? Hopefully there's an actual innovation at the core, not just a pricing arbitrage. And the way that I think that I always coach founders to look for that is to ask yourself the question, is there something that is hard for everyone else that is easy for me? And if you have an answer to that question, that is an amazing thing to start a company around. There's something that I see about the market. There's some process that other people are doing it or the wrong way or have been doing it the wrong way for years. They're sort of not thinking about the problem right. And then if you have that, you have the license to start. And then you have to figure out how to defend it once other people figure out that you've done it better. But that's always the place to start. Is there something that I can do that other people would find it incredibly hard to do? And if that's true, that's a great reason to start a company.
Excellent. Yeah. And I guess to finish things off then, I mean, if there's anybody listening who's, obviously interested in working with QED going forward, I mean, what advice would you give to those companies?
I think the first thing is answer those questions and come reach out. We're looking for mainly is we tend to invest more at the Series A or the Series B than at the seed these days. We have so many great seed stage funds in the US that we've decided that it's probably better for us to go a little bit later. We can partner with our friends. Occasionally we'll write small seed checks when our friends are leading rounds. But that level, we can really say, look, at the Series A, there are some basic questions we want to know. And they're actually harder than you might think. Like, have you tripled in the last 6 months? Do you have more than $1 million in revenue? Is there a credible path for you to have more than $100 million of revenue in the next 5 years? And I think a lot of startups think, oh my gosh, I got there, or I'm at this $1 million plateau, now I can raise my Series A. And we just remind people for truly venture scale outcomes, the questions are just that simple, right? Are you growing fast enough at the early stages to reach escape velocity? Will you still be growing fast enough when you hit $100 or $200 million that public markets or large PE buyers will think that's exciting? Because if you're going to top out, oh, I can get to $100 million, but after that, I'm going to flatten out. Well, that's actually not that interesting. That's a great business for sure. And most companies will never reach it. But what we keep on learning is that in order to get to exits, you have to actually be building companies that still have a ton of momentum, even when they get to scale. So for us, that's probably, as we've refined our thinking, as we become more professionalized, we've really focused on those questions more and more. Not just, is this an interesting young company growing fast, but is this an interesting young company with world-changing ambition and potential? And so those are the questions we spend most of our time thinking about.
Thanks again, Amias, for chatting with us today. To close out the podcast, we have our now infamous Fintech Jails. This is where we ask for an industry term, buzzword, or trend that you've seen or heard enough of. Or, of course, you can advocate to free one of the previously incarcerated terms. So what would your selection be for this week?
So I'd like to put first of its kind in venture jail. So a little bit more broader than fintech. But I think especially at the early stages, we often have companies claiming first of its kind. And I think in the age of AI, this is particularly true because there are a lot of things that AI enabled that really were truly difficult just 2 or 3 years ago. But it's almost never true. It's almost never true for 2 reasons. One, if you've had the idea, there's probably some other team going after it. And so what we want to hear you say is, why is our approach different and differentiated, not just the first to try doing this? And then the other thing is that oftentimes, especially in light of AI, it might be that it's the first time it was possible, but it's almost never the first time it was tried. So what we love to hear, and it's just instant credibility, is rather than claiming first of its kind, latest of its kind, or here's why this will work now that it wouldn't work before. Here are the 10 people who tried it in the late 90s, in the early 2000s, in the 2010s, and here's why finally it's possible because of our insight. Those are the things that raise credibility. So anyway, that's my venture capitalist jail. I never want to hear first of its kind.
Yeah, no, it does sound like a good one. I mean, if you were speaking to a founder of a company and they use this in a pitch, would that be an instant no from you? Would that just...
It's pretty close, Paul. It's pretty close. I'll often give them like one try, right? Well, what about, because, as a venture capitalist, we see this all the time, right? Well, what about this? What about this? What about, we can often come up with a counterexample on the spot, but it's very, very rare that, and sometimes people say, yes, but we're still first of this particular kind. But again, it's generally a credibility destroying phrase.
Excellent. Well, yeah, I'm more than happy to throw first of its kind into the jail then this week as the first new inmate of 2025. We'll have to wait and see over the course of the year whether someone wants to advocate to free that one, but I have a sense that one might be in there for a while. But Amias, thank you so much again for joining us for the podcast today. It's been a pleasure.
My pleasure. Well,
that's all we have time for this week. Thanks, of course, to Amias for joining me. As for Fintech Futures, you can find us online at fintechfutures.com. Be sure to follow us on LinkedIn to keep up with the latest fintech news. If you like this podcast and our other episodes, you can subscribe on Apple Podcasts, Spotify, SoundCloud, or your favorite podcasting service to get notified about future episodes. Thanks as well to Arama for editing this podcast. You can check them out at arama.tv. As always, thank you very much for your support, and we'll see you soon for another episode of What the Fintech. But until then, goodbye.